You're watching Deal Flow. This is CNBC Africa's show that tracks merger and acquisition activity in South Africa and beyond. Internationally, competition regulation and legislation is playing an increasing role in determining the viability of mergers and acquisitions. Locally, the observation is made that public interest criteria are amongst the determining factors in whether our competition authorities will allow a deal or not. We look at this in some detail, but we start with Deals of the Week. New York-listed hotel chain Marriott International is buying a South African hotel chain, Protea, for $186 million in a deal that will make it the largest hotel operator in the Middle East and Africa. Protea has 116 hotels with more than 10,000 rooms in 7 African countries. India's Bharti Airtel plans to sell most of its transmitter towers in Africa in a process that could raise up to $2 billion for the telecom operator and help reduce its debt. United States buyout firm Carlyle Group and South Africa's Investec Asset Management made a private equity investment in a Mozambique-based transport firm, J&J Africa. And BlackBerry says it intends to divest the majority of its real estate holdings in Canada as it seeks to bolster its balance sheet and turn around its fortunes. The competition practice at Webber Wentzel argues that public interest criteria continue to play a pivotal role in the South African Competition Authority's assessment of mergers and acquisitions. As a result of its strict checklist, a number of recent deals have received only conditional approval. Robert Wilson is a partner in the competition practice at Webber Wentzel, and Trudi Makhaya is Deputy Commissioner at the Competition Commission of South Africa. Welcome, really good to have you here. Robert, I'll start with you, seeing that it was one of your colleagues who expressed this opinion. Are you seeing this as an intensification compared with, say, 5 years ago, even 3 years ago, the public interest criteria applying?
Erika, I'd say it's an intensification of the 5 years ago, and I think very much following the precedent-setting decision of the Competition Tribunal in the Metropolitan Momentum transaction, which was then acknowledged and accepted. The test that was laid down was acknowledged and accepted by the Competition Appeal Court in the Walmart matter, which our firm acted for Walmart there. The criteria, though, are very, very important to consider. And first of all, public interest is specified in the Competition Act. It doesn't mean anything to everyone. The public interest factors are limited to employment, the effect on SMEs and previously disadvantaged individuals and to make them become competitive in the economy, a particular sector or region, and also the international competitiveness of South African firms. So within the constraints of those specified grounds, the public interest assessment needs to play itself out.
So let me just interrupt you there, Trudi, and I'm sure you've had many philosophical arguments about this particular point, the public interest criterion, the job creation or job losses retrenchment aspect of an M&A deal, and the argument being that this has nothing to do with competition or the realm in which you function. What was the trigger for that decision to bring that principle in?
I think those principles have always been in the legislation, and I think it's just over time that the law develops to give expression to how they should be applied. So, I mean, our legislation looks very much at balancing or examining both competition and public interest issues, because I think it was acknowledged that, you want to have competition in a market, but you also want that competition to work within a context of South Africa in a way that's transformative of the economy given our history. So we have both of those elements to it. And I think I should emphasize that in assessing public interest, there are clear criteria as to what should go into that. So in terms of our discretion, it's limited by what's in the legislation. It's limited by the fact that our recommendations would still go to the tribunal. So there is scrutiny over what we would say would be conditions inspired by public interest considerations.
So Robert, in practice, do you agree with this last statement that Trudi made, that it's very clear, it's laid out in the law, that you know exactly what those public interest criteria are? When you take one of your clients' deals to the Commission, do you know what the outcome is going to be? Not
necessarily, and that's the great challenge for deal makers, is to anticipate how the transaction may be scrutinized and to plan or to expect the unexpected, if you like. That goes into the timing of your transaction and the possible implementation of it once it's approved. and also the costing of the transaction, because it may be that conditions are imposed that cost the parties. So, for example, if there is a condition imposing a moratorium on retrenchments, as we saw in the Momentum Metropolitan transaction, that comes at a cost. The parties anticipated extracting a particular efficiency from potential redundancies, and they were denied to do so for a period of time. Similarly, if there is a condition requiring the retraining of retrenched employees, that too comes at a cost. But even before we get into those uncertainties, there are significant uncertainties in the investigation of the merger. So the Commission, increasingly in the context of employment-related concerns, is increasingly asking for a lot of information and for the parties to justify the number of retrenchments that they anticipate. So deal makers do need to anticipate these cost and timing implications. But with that comes the point of uncertainty around where the Commission might go.
So Trudi, how do you balance what seem to be conflicting elements here? On the one hand, you need to do your job and comply with what the law says and apply that to potential deals. But at the same time, what you're hearing from Robert is that these requirements cause delays. They add to transaction costs. So it would affect the merits and the viability of the deal being brought to you.
I think you raise an important issue around the merits of the deal, because I think it's just good practice to think very carefully about the business case of a deal and where you think you're going to extract those efficiencies. And if it's clear that to you that you're planning to extract the efficiencies in a way that might fall foul of the provisions. I mean, I'll give you an example. If it's clear to you that you're merging with an international player with an intention to shut down manufacturing in South Africa and only have distribution, that's something you would have thought about very deeply in developing the business case. So I would disagree slightly that it's that uncertain. I think a lot of actually the insight into what the likely public interest issues are going to be comes from the people putting together the deal in thinking about the value proposition. So I think in thinking about those issues, in the example that I gave, that it becomes clear that, okay, when making this case, these are some of the conditions we might have to put forward to the authorities to limit the impact of that, external outsourcing of jobs. That's something that can be anticipated, that's something that can be managed. And also, just business people understanding the general policy environment, that in an environment where you're trying to create employment, generating growth, certain strategies would be more difficult to implement than others. I think that's our reality. And I think bankers should be aware of that.
Many philosophical arguments related to what you just said, because it's actually not relevant here, but I would argue you create jobs by creating an enabling environment in an economy and doing all sorts of other things in the training, governance, bureaucracy areas to stimulate job creation rather than possibly stifling investment. So Robert, if I were to ask you, from your perspective, if you've got potential international deal makers coming to South Africa, how do they react to our requirements? Are these the kind of requirements that they might find elsewhere in the world, or are these typical of emerging markets wanting to protect?
Typical of emerging markets, but what you do find in other more developed economies is the fact that you have investment screening regulations and authorities, which we don't have in this country, and which is one of the reasons why the Walmart deal was so contested around public interest. But in essence, it was to assess the quality of the investment being made by this foreign investor. Where I would slightly disagree with Trudi is around the uncertainty. You do find a far greater willingness on the part of the Commission to impose conditions when it is an intermediate merger which needs to be decided by the tribunal. A large merger is decided, an intermediate merger is decided by the Commission. A large merger is decided by the tribunal, and certainly in my experience I found that those large mergers, the Commission is somewhat more circumspect in the conditions that they recommend to the tribunal. What we found in intermediate mergers, and a good example there is the Kansai Freeworld transaction, a number of conditions being imposed by the Commission as decision maker, which was somewhat opportunistic, requiring the foreign investor to invest in research and the like. We see far greater transparency, in my view, with large mergers ultimately going to the tribunal. That being said, it's not a criticism of the Commission, it just may be where the Commission was at a particular point. What we have found in relation to mergers that are being investigated by other competition authorities in Africa is a far less rigorous approach to the competition public interest weighting. And that might be the way that their legislation has been drafted, where in a sense it's just a simple list of factors. You certainly find that in Namibia.
Yes.
But in South Africa, we've now been given authority by the Competition Appeal Court and a tribunal to apply the assessment in a particular way.
Trudi, I'm sure you want to react to that. If you could also include in there, is there discussion between yourselves and other competition authorities in the Southern African region? We've heard criticism of some of your peers it being quite expensive, because when you notify them, you have to actually pay a fee. You don't have that requirement, not to that extent anyway, so that creates problems. So do you discuss it with them?
Yes, I mean, we do have filing fees in South Africa, but yes, in other jurisdictions it's been raised as a problem. We do engage with other parties in the rest of the continent. I think what we do find is that in many other countries, rest of the continent, but also in the developed world, public interest considerations are taken into account, but often in a very political sense. You know, sometimes the responsibility would even lie with a government department. And I think here we still have a system where it's still independent, it's still rigorous, it can be questioned. So in that sense, I also think there's less uncertainty or difficulty, because parties, even when they feel that they're being disadvantaged, can put their views forward and to say what they think would be more appropriate conditions. With intermediate mergers, we take the final decision, but of course parties can approach the tribunal. I think just maybe because I'm thinking of issues also as an economist. With a lot of intermediate mergers, I mean, it's driven by size. And you find a lot of industries where it's a very small supplier of inputs, but they're the only supplier in South Africa. Or they've got very close vertical relationships with other players, possibly because they are a fairly small company. And then a lot of that has to be undone, Chinese walls, etc. Or they belong to a portfolio with other big companies, and you have to have conditions about how directors interact with them. So I wouldn't say it's necessarily that the difference is about whether who's taking the decision and we're more circumspect in others or not. I think it's also to do with the nature of an intermediate transaction.
I'm going to stop you there, but Trudi, I do want just final comments from you. Just standing back, big picture, what's the deal flow that you're seeing, the applications for your consideration? Is it picking up? It's
always picking up in January, because you've got a lot of deals that would come in through December. Over the past 3 years, we've had a growth rate of about 10% year on year. So it's still moderate, not quite the highs that we had before the crisis, but it certainly is on an upward trend.